When we first came on the market, we got a lot of death threats from photographers, actually. It was just really intense.
What tactics are you doing to convince customers to be like, you should do an Easter shoot?
We floated the idea of getting more funding, but everyone was like, no one's going to give you anything. Like, there's just no way.
So what did you do to turn the business into a profit-generating machine?
I had so many friends that were so talented, but were so poor. No matter how talented they were, they couldn't cobble together enough work to stay the artist they wanted to be. I was like, this is sad because the arts make the world a better place. The only thing that I would have changed is Hey
everyone, welcome back to Fundraising Demystified. Today we have Jennifer Tsai with us, founder and CEO of Shoot.com. That's Shoot with 2 T's. And Jennifer, I'm really excited to have you on the show because your business is very close to my heart, mainly because a past that most people don't know about me is I used to be a professional photographer. And my first real tech startup was basically an identical replica of what you have, just 5-6 years prior. And I'm just excited to talk about kind of your strategy, how you raise money, and kind of how you decided to make this a one and done fundraise and move on to profitability, which I think is a more common story for so many founders this day. So Jennifer, thanks for coming on the show today.
Yeah, thanks for having me.
So let's just kind of get started. What is Shoot.com?
Yeah, so Shoot is a professional marketplace for photographers that are they're working professionally. We're trying to fill all of their supplemental time with gigs. And, what that means is for the client, we're able to offer them free photo shoots, free mini photo shoots. They're free to book and you only pay for the photos you want because we're able to aggregate demand at specific locations. So photographers end up having a day of back-to-back sessions. Normally, when you are a professional artist of any kind, the biggest problem is trying to kind of cobble together enough work so that you can make a living off of that. So we were like, hey, can we fix that with a business model that kind of turns on its head, that you're not spending all your time finding gigs, doing all of the business to support it, but you're actually focusing more on photographing because we're handling all of that business activity. And so that's kind of that was really what helped us make Shoot. And, we've been around for close to 7 years now, and we're very proud to have a 4.9 star rating on Google, and we're in 60 cities across the US.
It's super impressive because this is ultimately what I had hoped for my business back in the day called Toggly to end up being, but we focused too much on trying to raise capital and less so much on just knowing that we actually had a good business. It just actually wasn't venture backable. So first thing I want to start off with is you're a marketplace. So you have supply, you have demand. So on the supply side with the photographers, just an experience I had, was there any pushback of standardizing pricing and kind of coming out with this business model with the audience that you try to pursue? And how did you get that initial kind of supply side set up?
Yeah, that's a really great question. And we had so much pushback. I think anytime you have a marketplace for artists, they just get very upset, understandably so, that they're getting taken advantage of, that they deserve 100% of the money, like all of that stuff. I understand why they feel that way. There's so many people who are not necessarily operating in a good faith place. But because a lot of us started as creatives, the whole thing was we wanted to create something. We wanted to see if we could have a business that was like a win-win-win for us, photographers and clients. So, a lot of the pushback is that they did deserve all the money. And so there was a huge education component that we had to say like, hey, we're providing all of these services that are actually really expensive and time consuming that you don't want to do. So then we had to really articulate that we're not for every professional photographer, but if you are a certain type of professional photographer that has supplemental time and you want to fill that with gigs that just come to you like easily, we handle customer service. You don't ever have to deal with that. We handle sales, gallery delivery, all of that stuff. That's and marketing. Marketing's a huge piece of it. Finding clients and being able to do that in a cost-effective way is really hard to get that kind of volume. So that's what we anyway, so that was the education piece. But, when we first came on the market, we got a lot of death threats from photographers, actually. It was just really intense. And that's, it's so hard when you try to help people. And the first thing that they say to you is they want you to die. And so that was just something we had to deal with. And, that just really compelled us to have to figure out how do we articulate our value proposition to photographers. So,
Well, there's a written record of my death threats on an article written about me 10 years
really?
ago.
You had the same thing?
Oh yeah, I did a lot of media, and I got ripped. I got death threats. I got all kinds of things when we did that. So, I empathize for you and kind of what happened there, because everyone has a very strong opinion, and especially artists, because ironically they spend the time that they have not taking the whatever $150-$300 they might get working for you, but harassing people online.
No, it's true. And we even we know that the offer of the free photo shoot from a provider point of view sounds like we're taking advantage of it. It doesn't sound possible, right?
Yeah.
So what we had to, that's exactly right. And so we get a lot of you guys must be a scam. So what we do to counterbalance that is we provide a minimum guarantee of $100 per shooting hour for photographers. And then we do whatever we can to try to protect their time. So if they even show up, if they show up and the client cancels, they get a fee. If they're late, they get a fee. We try to pay them for everything that we can get money from to try to help them. And then, again, it's it's really hard to override that. People don't like disruption like this, which I totally get, but it does make it tricky.
Yeah, no, but that's how these marketplaces, that's why I'm spending time on this, is just because marketplaces are hard, because we're only talking about one side, and that's supposed to be the easy side. Hey, I'm going to give you money.
Yes.
Now you got to go get the demand side. So how did you manage to fill their calendars, and how do you go about, getting the supply side or the demand side these days?
Yeah. So we were really lucky because when we launched in 2018, Facebook ads were so cheap at that time, at least for us. It was like shooting fish in a barrel. Their targeting was so good. And really it took off once we figured out who our target market was. So in the very beginning, we assumed that it would be millennials and younger folks that wanted photos, because it was right when Instagram was getting really popular and having really high quality polished images was really in vogue. But then, it was okay. But then it really took off when we realized that our target demographic are millennial moms and Gen Z moms. People, once you have moments that you want to start capturing with photos. So that's really when people are dating seriously, or they adopt a dog, things like that, and then they get married, and then they get pregnant, and then they have children. Your children look really different, and even within 6 months. So those people constantly want professional photos. So once we started targeting them, that's where we got a lot of the bulk of our clientele, and between Facebook ads, Google ads, that's where, and a lot of guerrilla marketing, that's how we generate demand.
No, and that's basically been a scalable model for you guys to this point. But let's go back to kind of the early days and kind of talk about what this show is all about when it comes to raising money. So you raised a little over $2.5 million. Walk us through kind of when you decided to raise money and what your game plan was for securing that capital.
Yeah. So I have to say that I am really privileged in this area, because one of my co-founders / chairman is a serial investor entrepreneur himself. So in the very beginning, once we figured out that what our target demographic was, and we were advertising to them, and we realized, our acquisition cost was so low, our growth was really exponential. So we grew super fast. Even the first year, I feel like we went from $80,000 of top line revenue to I don't know, something you know what I mean? 500,000 the next year. So it was just, and then we went to $1 million. So it was starting to really look, what it looked like was oh, we have hockey stick growth. We just put money in it, and it's just very exponential. And so during that time, that's when my co-founder was let me just ask all of my friends for a friends and family round. And he cobbled together, that slightly over $2.5 million in the very early years, which was very lucky because I didn't have to really do any pitching, which is, I know, very unusual. So he just tapped into his network, and the money just came in. And then iOS 14.5 happened, where all of a sudden our acquisition costs started to skyrocket because there was Apple privacy put into things. So it went from, it only costs us $20 to get a client. Now it costs anywhere from $50 to $200. So that's all of a sudden that changed how everyone, including all those investors, saw us. And then we knew our trajectory had to change.
That's pretty brutal.
Yeah.
Yeah,
No,
two
it
two
was
and a half x to
terrifying.
10x ROAS, or not even cost to acquire a customer going up that high.
Yeah.
So it's a good thing you did raise the money, because you probably wouldn't have survived if you didn't raise money beforehand.
That's completely correct. Yeah.
So I do want to. You said you didn't do much, but at the end of the day, you did drive hockey stick growth with very limited capital before raising capital.
We did. Yes.
So you did do something. You made yourself attractive in the first place.
We did. We did.
So why did you start the business?
Oh, great question. So I started the business because I actually come from a background where I've like a strong background, and I did investment banking, I did corporate finance, all of that stuff. And then I transitioned into being an artist. So I was an actor and still am sometimes, for like a little over 10 years. And so I had so many friends that were so talented, but were so poor. No matter how talented they were, they couldn't cobble together enough work to stay the artist they wanted to be. And it really stuck with me, because it didn't I was like, this is sad, because the arts make the world a better place. Right. And so it kind of rattled around in my head. And then I reconnected with my co-founder chairman, like a decade after I worked for him, actually. I worked for him at a startup. And I was like, you know what? I know I need another type of day job. And I feel like a startup is the best use of my skills. Like, do you know of any hiring? And then we got together, and he was like, and we realized, I was talking about my background, and we realized, oh, hey, like, can we make a startup that helps the gig economy for artists? And we realized that we could do it for photographers. So that's really where it was born, where we're like, hey, how do we keep artists? So that was really the impetus for what we did. And that's how it was born.
There you go. And when it came to that 2.5 million, you had the major shakeup on your cost to acquire company, or customer going through the roof. How did you mitigate, and kind of what was your plan thereafter? Was it to go back out and raise more money? Was it to figure out profitability? Kind of what were you dealing with at that time when the costs were going up so high?
Yeah, no. So when that happened, that was the only time that I really had a genuine panic attack about my business, because we started the business, and a lot of us are very we're good operationally and good at processes, but none of us were experts at marketing. We had just it was like we ran Facebook ads, and no one had a background in it, but you could figure out their platform. And so we're like, okay, cool. So then we were like, we actually have to learn marketing from scratch. So we have to, we were just guessing before. So that was kind of really the tall order. We thought about we floated the idea of getting more funding, but at that point in time, everyone was like, no one's going to give you anything. There's just no way. So you have to figure out how to make it work yourself. And that was really terrifying. So out of survival, we had to really learn the nuts and bolts of marketing from scratch, and think of ourselves as that kind of, the kind of company to see hey, I know we had a good idea and we could scale, but do we have what it takes to also be a profitable long-term company standing on its own 2 feet? So that was really what drove us to then focus on doing that. And I'm like, I think we can. I think we can do it. So that's what kind of put us on that path.
But what did you do? What did you change in the business? You had the cushion, you raised money at the right time to give yourself that flexibility to kind of make the decisions. So what did you do to kind of turn the business into a profit generating machine?
Yeah. So there's nothing sexy to tell anyone. We just had to we signed up for every marketing newsletter on the planet. We figured out how to track attribution ourselves, and we've built proprietary spreadsheets to really track every single platform, know how it changes on a daily basis, be able to catch it when it starts to trend up or down. If it starts to trend in a good direction, magnifying that and putting more spend there. If it starts to trend bad, trying to figure out if it's us, if it's just and just being so strategic about that. That's what it is on a daily basis. And then, cutting any sort of incremental cost. So we don't pay for space. We're fully remote. We don't do any sort of experimental spend that is out of control. So it's I would never do a $50,000 ad campaign that I have no idea how much it's going to work. I need to know that it's going to get me results. So it also changed our culture into one of testing, constant small scale tests to see what works, and whatever works, we do more of, and whatever doesn't work, we let go of. It doesn't mean that we'll permanently never do it. For example, the first time we tried connected TV ads, it didn't work. And then we tried it again 2 years later, and now it works for us. So it is with the mind that we'll try anything, but we'll try it for a very short amount of time. So it just changed the discipline that we had about running everything in our business. Instead of oh, let's wait and see. There's no wait and see. Like we'll cut you off within 10 days, basically.
Well, smart.
Yeah.
And how do you, like, again, for any marketplace founder out there that might be listening, like, how do you balance the supply demand that, it's like, okay, you got photographers, but if they're not getting booked, they get disengaged and maybe don't, respond as much. And if you don't have photographers, you can't get customers. So how do you manage that balance?
Yeah. We're monitoring the supply demand balance so we're in 60 cities, right? So we have to know how each city kind of performs. Like, do we have too many photographers or too little photographers in each city and for the demand that we get? So we really do monitor that on a city by city basis, and we kind of know what their capacity is. And then we're hiring kind of all year round, and we have to be very specific that unless you're in like certain markets, that your demand will be very seasonal. So the biggest season is fourth quarter. So that's where it's holiday card season. Yeah. I'm sure, you're familiar with that. And so that's where we can't have enough photographers in most places just to fill the demand, right? Because that's when people really want it. But so then it gives us the onus of okay, what other holidays or events do people want photographers? So like graduation, Mother's Day, Valentine's Day, summer vacation. If there's these other smaller micro moments, how do we advertise for those better and drive the demand there? And then are we hiring enough photographers knowing what our demand was in previous years for really aiming for fourth quarter to make sure we get the most of that to keep growing every year? So it is very much, we're looking at both.
No, it's incredibly difficult. And one of the big reasons why, we couldn't raise money when we were launching, Toggly was one, the disbelief that the frequency of use, so a big marketplace problem for a lot of founders is there's not enough frequency of use on both sides to, drive LTVs high enough to justify the CACs. And so a lot of investors just generally don't like these types of marketplaces for that reason. It's how many times are you going to really use a photographer every year? But you kind of hit that point there in terms of how do you generate more demand per year beyond just the Q4 kind of seasonal amount? So what tactics are you doing to convince customers to be you should do an Easter shoot?
Well, the first thing is anyone who owns a marketplace, you need to be really on your emails. You have to know when that demand might hit and just religiously email people without being too annoying. But honestly, I'd rather be annoying than miss an opportunity. So just make the most of your email list for sure. And then, we do things we sell bundled packages where it's hey, get 2 or 3 shoots in a year, 2 or 3, and then you get a significant discount. Some people will really opt into that. Then you try to get first party data from them as well to be hey, it's your birthday. It's, this event or that event that you might be interested in. Give them a discount, try to drive them to book a session. So there's all sorts of little things to think about, but it's a lot of meticulous planning on, in the email journey, in your marketing to try to hit these people.
You're likely having trouble raising money or selling your company. Personally, I've had 4 exits and I've raised over $145 million. If you want a free coaching session with me, just subscribe, and leave a comment down below letting me know what you think of today's video for a chance to win a free coaching session with me. I'll select 3 winners every single month. You just have to subscribe, and leave a comment down below for a chance to win. Now, onto the video. No, it's absolutely crucial. I think any consumer facing business, you have to be accelerating on the points that you've already touched on, to just the granularity in your marketing, to the paid ads plus email, to kind of have any shot at being able to generate enough cash flow from a customer and get them to spend more on a regular basis. When it came to this decision of you got to build a business profitably now, and you've figured out the kinks in the business to do so. Can you share with the audience some of the numbers behind your business, kind of back then, and maybe how you've grown today and kind of where you're at in terms of either top line revenue or profitability or just your unit economics?
Yeah. So I think the first year we were at 80,000 of top line revenue. We were in 1 city. We were lucky to grow exponentially during the pandemic because we were one of the few activities that was outdoor and socially distanced. So you could hang out with your family and have a good time and have your memories without getting sick. And so that was something. And then there was also less competition with marketing. So that was actually a really fortuitous time for us to grow. And now we really hit, so we were really lucky because in 2023, we finally hit break even. And that was a big deal for us. And, we hit break even. Our customers are spending on average like between 180 and 190 a person, which is really great. And then in 2024, we actually we hit break even with 8.8 million of sales in 2023. And in 2024, we 20x to that profitability. So we went from like 45,000 to close to $1 million. And then on a top line revenue of 10 million, 10.2 ish. So that was a huge accomplishment for us. And because of the way that we work, we actually don't know what our financials are until January of the following year, because we have this like annoying tail of like, hey, pay only for the photos you want, right? So that means that there's a lag. They're not paying when they book the session. So we don't know how people are going to buy from, and people are kind of struggling a little bit during the holidays. And then we know in January, like, oh, I'm positive we're profitable now. So there's just like, we're holding our breaths for those last few months. It's kind of brutal, but
painful.
So then our whole year is really about, can I design my business? Can I set everything up for success well enough that we can stick the landing? And it's kind of like, if you do enough of the right stuff, it should stick the landing by itself. But there's like a lot of anxiety about that every year for that.
Yeah, that's intense.
Especially
that payment model. Like, are you paying the photographers up front regardless of the payout?
Yeah, so we pay like part of their guarantee. We do that. We have that $100 minimum guarantee, and then we pay whichever one is higher. So we give them that, we upfront that to them, and then whatever commission they earn on top of that, we give to them afterwards. So they have kind of rolling money coming to them twice a month, which is great for them.
How do you manage that cash flow wise? That sounds brutal. It's like, oh, I love these pictures, but I'll buy them in like 3 months from now.
Yeah. So, I mean, we have like an email journey again, try to really compel people to buy. And then we just have to be really good about our finances and, understand how our working capital is, because like, it's like once you hit like October, then the money really pours in. So it's about like figuring out how to spend that wisely through the rest of the year so that you can kind of survive until the next season.
That's a fun game.
It is a fun game.
So, now that you got to establish, and kudos, 10 million top line, very few businesses can make it to that level. I always thought back with, targeting our business, like that would have been like the goal would have been, 10 million top line. And so you've achieved that, and, not a bad timing. I think, 7 years to get there is actually pretty reasonable. What would you change? Would you go back and change anything after kind of seeing what you've done and how you progress? Is there anything about the business that you would have gone back and wouldn't have done that?
The only thing that I would have changed is I took some bad advice early on that we don't need to have the best accountant. And I completely refute that. That is the only thing. We had some, I think certain accounting rules changed really early, like in the early years that we were in business. So we didn't realize there was a bit of a shift. So then we had to end up paying things when we made things right. We ended up having to shell out like close to $300,000 of money that we should have paid, like could have been captured and paid up front. So that's the one big regret that I have.
Have a good accountant. Yeah. Honestly, I've dealt with so many companies. I work with companies on capital raises all the time. And like, one, I either can't get the books, which is like huge red flag. Like, it's just like, they're working on it. They're working on it. It's like, you need to fire that team now. If it takes more than, especially some of these businesses, they're not that complex. They don't have that many transactions. It kills the fundraise. Like if you can't demonstrate the management of your books, or you have like just gross negligence in the management of your books, it's such a deterrent for any outside capital to potentially come in or just make your business totally screwed, whether it's back owed taxes or just mismanaged cash or not knowing what your cash position is truly.
Yes.
Like, you know what your payables are, especially with your cash management of like pay, then get paid situation. You really need to have predictability in that front. Otherwise, you could have a great business, but be cash poor.
That's correct. Yeah.
So that's good advice. I don't hear the complaint about accountants enough on this show.
Oh, really? Oh my God. It's like the one thing.
Well, that's of all things to complain about, that's a good one to complain about. If you had other things, there's always something worse out there.
Yes.
And now that you've hit this milestone, 10% EBITDA, or 10% profit on 10 million revenue, that's fantastic. you're now bootstrapped. You could basically choose your own destiny. What are you thinking? What's next for Shoot?
So this is where I am like at the end of my road in terms of my expertise. Since I've never sold a business before, I don't know what the best path is forward, just to be like totally transparent. Like, do we try to get VC funding to try to supercharge some aspect of what we've done? That's a possibility. Though I understand, the whole VCs don't like service-based like platforms, all of that marketplace, all of that stuff, right? Do we try to get bought out, or do we try to like do we just try to run it forever? So there's like, we look at it and I'm like, you know what? I don't know what's best for us, but I just know that I want to do what's best for everyone involved, at least on our side. So I don't always know how to make that decision because I've never done this before. So this is kind of like the interesting crossroads that we're at. But what's nice is like, I don't have to make any one of these decisions. Like I don't have to go get an acquire. I don't have to sell. I don't have to keep it. But like, I'm just like, again, I want to do what's best for everybody.
Jennifer, this is fascinating because this is what I deal with every day with founders. There's, what I kind of tell people is you built a business, you got to a certain, door, you've opened that door, and now you see 3 more doors. Mm-hmm. It's like, okay, sell the business, raise more money, stay the course. And how do you basically choose what to do? And what a lot of founders make the mistake of is leaning towards what past advice has been, raise venture, which was one of the first things you said to do. In a lot of cases, it may or may not be an option. The reality is like, you kind of mentioned your core of like, okay, how do I positively impact those already involved, those that were with you during this journey, that suffered with you, got to you at this point? How do you make sure all is well for everyone involved? And what I do with founders all the time is I walk them through what we kind of call a capital strategy assessment. So what I'll kind of share with you, and I'm curious to hear your thoughts, and this is for everyone in the audience as well. This is the secret sauce here. Basically, you look at those 3 doors. Let's just say raise more money, sell, or be like a long-term profitable business. And the best thing to do is actually get the data on what the market's dictating on those other 2 options of selling or raising money, and understanding if those are even attractive to you. Because like venture, in some cases, just using my knowledge back in my head, probably not going to be interested. Just mainly because
Absolutely.
You're more kind of in the early stages of growth equity, but you're kind of too small for your traditional growth equity. So it's more like the smaller players are going to come in and they need to make money on you. Mm-hmm. And marketplace economics, there's a bunch of factors that come into place, but you might be priced on a multiple EBITDA, not revenue.
Yeah.
And if you're priced in any category of selling or raising capital and you're based on EBITDA multiples at your business, at your scale, you're probably not going to be in love with the number that you get day one. And then it's like, okay, that's where you are today. What gets you beyond that hump? So what gets you that higher multiple? What's the arbitrage play that gets you from like maybe it's a 5 to 8x EBITDA multiple to maybe like a 2-3x revenue multiple? What changes would you have to make in the business? Yeah. Or if you can go from like a 5x EBITDA multiple to an 8x. And how do you manipulate the multiple game is where I usually like to start with a lot of founders of how do you figure that out? And sometimes it's subscription-based services, rolling out new services. Sometimes it's expanding into new sustainable growth channels. But there's always certain comps out there that can help founders navigate what actually moves the needle. In some cases, it's EBITDA. So like a 1 to 5 million EBITDA for your business, don't have the comps in front of me, but you would probably fall, depending on your growth rate and a couple other variables, in the 5 to 8x EBITDA margin. But if you have a high, like really great growth rate, which your EBITDA is great growth, but revenues maybe not as much, you could probably get to like 10 to 15, depending on the velocity and potentially owning a market and being a leader in the market. There's higher premiums that could be made from a private equity perspective. So I always root the expectation in a private equity standpoint and suggest founders that that's an outcome you can engineer, but for strategics, which are more ideal, so like maybe a bigger company, other marketplaces like a Thumbtack, who you probably compete with, would want to buy out your business and kind of roll it into theirs, and what would be the strategic value there. So those are the types of things that you want to look at, but they're hard to engineer. But like private equity outcomes are always easy to engineer. Not easy, but you can set a path on how to get there. So I know I'm going on a bit of a rant here, but this is stuff that gets me excited, and I help founders navigate this stuff all the time.
I love it. I love it because I don't know. Like, it's all new to me, so I deeply appreciate everything that you're sharing.
But the root of it is like North Star, and that's always any talk I give to a founder is like, "What's your North Star?" Some people like, just want to live on a beach. I was like, "Okay, well, how much money do you need to live on a beach?" And it's like, "Okay, well, you need to double the business, or you need to triple the business, or you need to fix this part, or you need to fix that part, and you need to do that in under 12 months at this velocity to then have this outcome." So that's something that I always encourage founders to think about is like, what's actually your number? And then what's your pref stack? So for you, it should ideally, you even have a 1x like pref on your capital raised?
What does that mean?
Yeah.
I'm so sorry.
The audience doesn't understand. A liquidation preference. So typically in almost all documents out there, from convertible notes, safes, most people have a liquidation preference of 1x, meaning if I gave you $2 million, if you sold the company for $2 million, I get my $2 million, you get 0. Yeah, it's basically the first, or if you sell for 10, $2 million gets taken out of the business first. They're guaranteed their $2 million regardless of their percentage, and then the rest is just distributed. And there's like participating preferred and non-participated. There's a lot there. But basically, the first thing you need to know is like, do you have any debt? And do you have any kind of liquidation preferences on your investors? Which usually I would factor in at least 1x, unless it's just a super simple safe. And in those cases, like, okay, if you're going to sell for 10, well, you raise 2.5, so technically only 7.5 will get distributed in those situations. And so you have to think about, is that enough for everyone to be excited about? Is that material? Is it not material? And that's always what I tell founders to think about is, know your options, know what's behind those doors. So if you chase an exit or raise capital, what's actually going to come behind that door and what do you have to do to be able to unlock that door as an option? And then does that even satisfy you? Is it worth doing the work to get to that point? And then there's, stay the course. Do you like your people? Do you like your team? Do you like your market? Do you like what you do? Like and you're profitable, and you always have that as an option, then there's certain KPIs that maybe you come back to this, these 3 doors again in like 2 years.
Yeah.
And, kind of say like, okay, selling for 10, 15 million is not interesting to me. Selling for 30 is. And it's like, okay, well, double the business, triple the business. You never know what the market will be, but that's something that is always good for founders to kind of look at and know, all right, if we went to market today, what could we actually achieve? And what's the marginal impact on the business that we have to make today to make an outsized impact on the return? And there's sometimes like recaps you can do. Like you don't have that. You have a pretty clean raise, but there's recapitalization. So basically getting rid of pref stacks and wiping out debt. And there's just like general cap table cleanup that can create massive outsized returns for the founders, not so much the investors. So there's just lots of creative deal structuring and financing, financial engineering that can create a material outcome because depending on the business, and I've talked to many from like SaaS to consumer to direct to consumer and so on, just knowing what your multiples are, doing that homework, doing that research, and knowing actually what the market's willing to pay for you now. And that's some of the most valuable information you can have as a founder to know what decisions you should be making right now to generate and engineer an outcome. So I'll get up my soapbox now.
No, and can I ask you a question?
Of course.
So right now is a weird time, business-wise. So how is that impacting kind of, I don't know if that's too general a question, but like, I feel like because people don't know what's happening economically, like how does that impact, a business, even in my standpoint? Because I'm just like, oh, with everything happening, it's so crazy. I mean, we're lucky that tariffs don't directly impact our business, but there's going to be, consumer confidence is going down. Does it impact us that way? Like, are people going to be spending less? All this. So then, when that is all roiling around in the market, how does that impact a business in my position looking to figure out like what's next? We think that we're just not going to do anything for a year or two, but do you have any thoughts about that?
So yeah, again, like going back to that door analogy of like, how does it impact door number 1 versus door number 2 versus door number 3? So the stay the course, probably minimal impact outside of consumer confidence. But that could also mean ad costs go down because not everyone's advertising as much. It could mean other aspects of the business, but it also mean photographers can't afford new gear. Does that really impact you? Maybe not. So that, I think, is not so materially to your day-to-day operations. But from a transaction standpoint, this is what I just had a call with one of our clients earlier today on this. Like, the macro market dictates what people are willing to pay for your business right now. Because when there's whether it's a risk-free return of government bonds to being able to go into equities right now, equities got dirt cheap in the last few weeks because everyone's sold off in the market. And most of the capital allocators that I know, especially family offices that have diverse allocation strategies, they're all piling into private publics. And because publics are cheap and predictable and easier to manage and in and out and liquid. So why would they pay the premium for private investing in funds like private equity, who might be the company that buys you and whatnot? So ultimately, privates have to lower their valuations and lower their terms and expectations to be able to re-attract public, but the money that's going to publics. Now, of course, there's always private equity money that's already secured and venture capital money that's already secured, that's deployable. But responsible fund managers, who ultimately you're going to want to be sold to a responsible fund manager, they have to look at what's happening in public markets to basically price and set the discount to whatever they should be buying you at, knowing of what might be happening in the markets in 3 to 5 years if they choose to be, look at liquidating you in that time, like reselling you at a higher price down the road to kind of capture their return. So that's the kind of like, the 4D chess, as they say, in terms of like looking at all the different layers of like, okay, well, really what you're trying to engineer an outcome for is for that private equity firm to flip you in 5 to 7 years. And like, they need to look at you today to see what they can do in 5 to 7 years. And right now, you're right. It's shaky. Deals right now, they're happening. There's people that are just, that's a beautiful part about private markets. So once the capital's secured in a fund, like, they have the autonomy to make decisions, but they usually will try to capitalize on the shakiness of public markets and try to negotiate better discounts. And then there's some, in venture where it's just like finger in the wind, they don't care and just throw money at any price. But in your case, selling, there has to be an outcome that can happen. And being that you're profitable, you can at least generate, cash flow for the time being, and hopefully there's sustainable growth channels. But if I were you in your shoes, at the very least, identifying any other channels of growth is going to be your most defendable moat that you can possibly have. And then trying to secure provable, I'd say, how you can increase LTV year over year is going to be pretty crucial as well.
Yeah, absolutely. Well, thank you.
Yeah, no, it was fun. I usually don't get to do that on the show where I get to like dive in specifically on this topic. It's, but since you brought it up, I was like, I got to dive into this one.
Oh, please do. No, highly appreciated.
We could always have an offline conversation too. But yeah, that's so kind of like taking a step back. Now that you kind of have that little bit of context, would love for us to kind of wrap up and have you share some advice to founders that might be either in the marketplace economy right now, gig economy in that world. What would be your advice to them right now?
Marketplaces are really hard. So if you're going to do them, I think you have to be really obsessed with process and like logistics. If you really love just being day in and day out to optimize like the minutia of how things are running, like that's what I feel like has helped us be successful, is that we're just kind of fastidious about all of the details to run a marketplace successfully and stay current, to deal with like, the day-to-day changes in marketing and being able to put out fires of like your different service providers. For us, our photographers, like the different problems that come up with that, figuring out pricing, like it's all of those little details add up to create an experience for both for us, our photographers and for our clients. And our ability to optimize that and always we kind of see it as like a game that we're like, how do we play this game the best? Can we make it more efficient? All of that's kind of what we do on a daily basis. And I feel like for a marketplace in particular, that's what's really helped us. So maybe it's not the same for every marketplace, but we have found that to be key for ours.
No, I think that's great. And I think that is generally what makes marketplaces so hard. You have to be on point and then ultimately systematize as much as possible.
Yeah. Super organized. Yeah. Otherwise, it's mayhem.
Yeah, it's absolute mayhem. I remember those days, and
Yeah.
I do not wish them upon anyone. Well, Jennifer, it's been absolutely amazing having you on the show. It's been a great blast for the past for me in terms of this general category and getting to talk about it. But if someone wants to learn more about you or Shoot, where should they go?
Yeah. So you can visit us at shootwith2ts.com. You can see our schedule of free bookable sessions. You can also follow us at Shoot with 2Ts at Shoot Photos on Instagram or TikTok. You can also connect with me at Tsai on Instagram or on LinkedIn as well. I'm also on LinkedIn. So love being on LinkedIn. So, come follow us, come, ask questions, anything. Happy to, connect with any and all of you.
No, absolutely appreciate your flexibility and being open to that. And you look forward to including that all in the show notes down below. And thanks again for joining us today.
Yeah, thanks for having me.
Thank you for watching today's episode. As a reminder, I'm your host, Jason Kirby. I have built and sold multiple companies with over 135 million in transactions as either a founder, operator, or investor across multiple industries. I'm currently the managing director and founder of Thunder.vc, where we help companies and founders at all stages navigate what capital to raise and who to raise it from, and help improve companies' odds of raising capital. If you need help, reach out to us at help.thunder.vc. If you like today's show, please share with your friends, give us a like or a comment down below. And as a reminder, this show is published weekly. And to get notified of new episodes and our newsletter, be sure to go to our website at join.thunder.vc. And if you sign up today, I'll send you a few freebies on how to negotiate a term sheet, how to get a free list of relevant VCs, and much more. That's it. No more shameless plugs. Thank you, and see you next week.